Hey guys, welcome back to Module 12. This is financial statement forecasting, where we're turning assumptions into a view of the future. So financial statements tell us where we've been, and forecasts tell us where we're going. So up to this point, most of our financial accounting work's been retrospective. We've asked what happened, why did performance change, where did cash come from, how effectively did management use the company's resources. But in Chapter 12, it changes the direction of the analysis. Now we're asking what might happen next. Managers forecast financial statements for many reasons: planning investments, evaluating strategy, estimating financial needs, budgeting cash, and considering acquisitions or divestitures. Investors and lenders also use forecasts to value companies and assess creditworthiness. But here's the most important thing I want you to consider. A forecast is not a prediction of exactly what will happen. It's a structured estimate of what could happen based on a set of assumptions. So from a manager's perspective, we really want to ask what assumptions are driving the forecast, and are those assumptions reasonable, and what happens if we're wrong. So we want to start by understanding the past. It may seem strange, but forecasting the future begins by carefully examining the past. The chapter calls this retrospective analysis. Before we use historical financial statements to forecast future performance, we do need to determine whether those historical numbers accurately represent the company's underlying economic performance. For example, suppose a company reported unusually high earnings last year because it sold a building at a large gain. Should we assume that gain will occur again next year? Probably not. That's something called a transitory item. The chapter describes the process of removing these unusual or non-recurring effects as adjusting, recasting, reformulating, or sometimes scrubbing the numbers. The objective is to identify the performance that's most likely to be sustainable, and that's our starting point for the forecast. So we don't forecast for exceptions. Imagine a company normally earns about $50 million per year, and last year it earned about $80 million because it received a $30 million one-time gain. If we simply take last year's $80 million and grow it by 5%, we've built a bad forecast before we've even started. That's why good forecasting requires judgment. Historical data is useful, but historical data does not automatically mean repeatable. Revenue is really the critical starting point. Once we've established an appropriate historical base, we begin forecasting, and the chapter identifies the revenue forecast as the most crucial forecast in the process because so many other accounts depend on sales. So suppose a company had $500 million in sales last year and management expects 8% growth. Our basic forecast would be about 500 million times 1.08 equals 540 million. That's easy. But the hard part is deciding whether the 8% is reasonable. Where did that assumption come from? A good sales forecast might incorporate historical trends, management guidance, economic conditions, competitive changes, pricing, expected unit volume, foreign exchange effects, acquisitions, divestitures, strategic initiatives, things like that. The PowerPoint illustrates that with Procter and Gamble, and shows why analysts look beyond the historical growth rate to management guidance and the company's business environment. So we want to challenge those assumptions as a manager. Suppose someone presents you with a forecast showing sales growth of 10%. As a manager, don't simply accept the spreadsheet. Ask why the 10%. Is the industry growing? Are we gaining market share? Are prices increasing? Are we selling more units? Are we launching a new product? Or did someone simply type 10% because that's what they hope will happen? The quality of a forecast depends heavily on the quality of its assumptions. We also want to forecast the income statement. The chapter forecasts the financial statements in a specific order. The income statement first, then the balance sheet second, the statement of cash flows third. Why do we start with the income statement? It's because sales and operating activity drive many of the other financial statement accounts. So after forecasting revenue, we can estimate expenses. For some reason, or some expenses, historical relationships to sales could be useful. For example, if the cost of goods sold has historically represented a relatively stable percentage of sales and we expect the relationship to continue, we may use that percentage as a starting point. But again, we don't blindly apply historical percentages. Suppose management expects significant productivity improvements or input costs are rising, or the company has gained pricing power. Those factors may justify changing the historical relationship. The P&G example in the chapter demonstrates exactly that process. Historical ratios provide a starting point, but management guidance and the MD&A information help determine whether those ratios remain reasonable. Also, we're going to look at forecasting because that requires the statements to connect. When we forecast the income statement, we move to the balance sheet. Many balance sheet accounts are related to sales. And think about accounts receivable. If sales increase, we would generally expect accounts receivable to increase as well, assuming customer behavior and payment behavior would remain similar. The same logic can apply to inventory and other working capital accounts. The chapter commonly forecasts these working capital accounts as a percentage of sales. But suppose sales increase and customers begin paying more slowly. Now receivables may increase even faster than sales, and that's an important forecasting insight. A forecast isn't simply everything grows by 5%. Different accounts respond to different economic drivers. So from a manager's perspective, sales growth can create a cash problem. Imagine management is thrilled by the company, is thrilled because the company expects sales to increase about 20%. Sounds fantastic. But what else might happen? We may need more inventory, receivables may increase, we may need additional employees, we may need more equipment, and all those things may require cash before the company collects additional revenue. So rapid growth can actually create a financing need. That's one reason financial statement forecasting is useful. It allows managers to identify those needs before they become emergencies. So forecasting long-term assets and financing. Not every balance sheet account simply follows sales. For property, plant, and equipment, the chapter uses forecasted capital expenditures and depreciation. Conceptually, the beginning PP&E, the capital expenditures, would be the capital expenditures minus depreciation equals your forecasted PP&E. So the debt is also forecast using information about existing obligations and expected financing activity. Retained earnings connects directly back to the forecasted income statement. So you'd have your beginning retained earnings, which would be the forecasted net income, minus your forecasted dividends would equal your ending retained earnings. So that's why this chapter emphasizes internal consistency. The forecasted statements have to articulate just like the financial statements do. You can't forecast one statement in isolation and ignore the effects on the others. Looking at cash as the plug, the chapter uses an interesting forecasting approach for cash. Cash is forecast last on the balance sheet and serves as the amount necessary to make the accounting equation balance after the other accounts have been estimated. The resulting cash number can provide extremely useful managerial information. Suppose the forecast provides a cash balance far below the company's normal level. Management may need to consider borrowing, issuing stock, or even selling marketable securities. If the forecasted cash is unusually high, management might consider investing the excess, repaying the debt, repurchasing shares, or increasing dividends. So cash isn't just the number that makes a spreadsheet balance, it's telling management something about the financial consequences of the forecast. From a manager's perspective, the spreadsheet says we're out of cash. Suppose that strategic plan looks great. Sales grow, profit increases, market share improves. Then you finish the forecast and discover the company is going to run dangerously low on cash. That's not necessarily evidence the strategy is bad, but it does mean management has another decision to make. How are we going to finance the growth? That's exactly why managers forecast the entire financial system rather than simply forecasting earnings. So when we try to forecast the statement of cash flows, after we've built the income statement and the balance sheet, we have that opportunity to forecast that statement of cash flows. The process uses the same concepts you learned in Chapter 11. We begin with forecasted net income and we adjust for any non-cash items. We consider changes in working capital, and then we classify the remaining balance sheet changes into operating, investing, and financing activities. That allows management to see not only what future profitability could look like, but also how much cash might operations generate, how much will we invest, and will we need external financing. That's where chapters 11 and 12 just connect really well. There's also internal consistency. That's another point in the PowerPoint that I think is extremely important for MBA students. Forecast assumptions may be internally consistent. Suppose your forecast assumes a severe recession. At the same time, you assume rapid sales growth, dramatically higher margins, faster customer collections, and no strategic explanation for any of it. Individually, a spreadsheet can calculate every one of those assumptions perfectly, but together they may tell an economically inconsistent story. Remember, Excel will calculate a bad assumption just as accurately as a good one. That's why managerial judgment matters. Precision is not accuracy. It leads to another excellent point. Spreadsheets allow us to calculate forecasts to an extraordinary level of precision. We can forecast revenue to the dollar. We can forecast ratios to 4 decimal places, but that doesn't mean the forecast is accurate. PowerPoint talks about specifically cautions that increased numerical precision can make a forecast appear more precise without making it more accurate. If your sales growth assumption is wrong, calculating the resulting net income to 6 decimal places it's not going to solve the problem. That's an important lesson for managers. Don't confuse mathematical precision with economic certainty. Sensitivity analysis. What if we're wrong? This is probably the concept I would emphasize most heavily because forecasts involve uncertainty and analysts commonly prepare multiple scenarios. This chapter describes a bull case, which is the most optimistic assumptions, a base case, which is reasonable assumptions, and a bear case, which is more pessimistic assumptions. Suppose our base case assumes a sales growth rate of 5%. We may also model 2% growth and 8% growth. Then we observe what happens to profit, cash, financing needs, and other outcomes, and that's sensitivity analysis. And it gives us a much better managerial question than is our forecast correct. Instead, ask which assumptions matter most and what happens to our decision if those assumptions change. Looking at this from a manager's lens, don't just give me one forecast. If we're evaluating a major strategic investment, I would be uncomfortable seeing only one forecast. I'd want to know, what does the base case look like? What if sales are weaker than expected? What if costs are higher? What if customers take longer? What if the economy weakens? And probably more importantly, at what point does this strategy stop creating value? That's where sensitivity analysis helps managers understand. So what I want you to know from Module 12 is concentrating on these ideas. The first thing would be forecasting begins with retrospective analysis. Historical numbers may need to be adjusted for transitory items because they provide a useful foundation for forecasting. Secondly, the revenue forecast is critical because sales drive many other income statement and balance sheet accounts. Thirdly, I want you to understand the forecast sequence, which would be the income statement first, then the balance sheet, then the statement of cash flows. And also, I'd like you to understand the different accounts that different accounts have different forecast drivers. So receivables and other working capital accounts may relate to sales. PP&E relates to capital expenditures and depreciation. Interest relates to debt. Retained earnings relates to net income and dividends. And fifth one would be trying to understand why the statements and the assumptions must be internally consistent. A forecast should tell one coherent economic study. You also need to understand what an abnormally high or low forecast cash balance tells management about the potential financing or investment decisions. You also don't need to confuse precision and accuracy, because a beautifully constructed spreadsheet can still produce a poor forecast if its assumptions are unreasonable. So, sensitivity analysis. Remember that we don't ask only what do we think will happen, we also ask what if we're wrong. That's probably the most important manager's lens from chapter 12. A forecast isn't valuable because it predicts the future perfectly. It's valuable because it forces management to make its assumptions explicit and connect those assumptions to financial consequences and prepare for different possible outcomes.